This video will help you understand your restricted stock units so you can best utilize them for your financial plan. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. Piggybacking off of my most recent video on employee stock purchase plans, I thought it'd be helpful to cover restricted stock units. This is a pretty common method of compensating employees with stock, and in my opinion, it's the easiest to understand. Specifically, I thought we would talk about what is a restricted stock unit, how are they taxed, and some best practices if you are someone that receives restricted stock units. So let's jump in. So what are restricted stock units or RSUs? Instead of your company stroking you a check for a certain amount of money, they will instead give you shares in lieu of that check, shares of their company. I know if a chunk of my compensation is based on how hard I work, I'm probably going to work really hard. And I'm probably going to work a little bit harder than if my compensation was not tied to the performance of the company. So psychologically, there's some advantages there as an employer compensating people with employer stock. Oftentimes there will be a vesting requirement on restricted stock units, and that would look something like this. Hi, welcome to XYZ company. Here's 100 shares. However, there's a 4-year vesting requirement. So instead of giving you all 100 shares at once, we're going to give you 25 every single year on your employment anniversary. The next year, when you'd be entitled to that next 25% tranche of vesting stock, your company most likely would give you another grant of restricted stock units, and that would have its own 4-year vesting requirement. That's an example. There's obviously more nuanced ways to do restricted stock unit plans, but to keep it simple, there's generally some form of vesting, and that motivates you to stay with the company. Otherwise, you miss out on that compensation you think you're entitled to. And it motivates you from day one to make sure that the company performs well, because your stock compensation in years 2, 3, and 4 are directly tied to the performance of the company, both today and in that 4th year. So the cycle really never stops. As an employer, it's a great way to motivate sticky butts in the seat to keep you employed there and to keep you working hard. As an employee, it's kind of nice because if the stock's on a tear, then you know, okay, I'm going to have a pretty good compensation in 2024 or 2025. And my company gave me X amount of stock today, but really that value could be exponential in 3 or 4 years. On the other hand, if the stock tanks over those next 4 years, I think we all probably would have preferred the cash. Now, to be clear, none of those stock benefits are yours until the stock actually hits your account. So for example, voting rights, dividends, and things like that go into owning a stock, you are not entitled to until that stock actually manifests into your account. Oftentimes, there's provisions such as if you die or become disabled, you will be entitled to receive the unvested portion of your stock. If you're fired for negligence or you're let go because your job gets absolved, then usually you'll lose out on that stock. Every company has their own provisions, but that's mostly what I've seen working in this space. Now, how are they taxed? The taxation of restricted stock units is governed by Section 1244 of the Internal Revenue Code. If ever you are concerned that you couldn't get more bored in your life, I'd recommend reading that. If you don't want to do that, to keep it simple, here's how restricted stock units are taxed. The dollar value of the stock as soon as it lands in your account, for all intents and purposes, is considered ordinary income. So rather than your company stroking you a check for 50 grand, if they gave you stock that's worth exactly 50 grand when it hits your account, according to the IRS, you made 50 grand and you have to owe ordinary income taxes on that 50 grand. Now, if the next day the stock goes from 50 grand down to 10 grand, you still owe ordinary income taxes on the 50 grand that hit your account. Now, if before the end of the year you sell out of that stock, then you can take a loss there. We'll cover that more later, but to keep it simple, whatever the fair market value of that stock that hits your account is, that's considered ordinary income. The taxes on your ordinary income portion of the stock aren't based on when you actually sell out of the stock. It's based on as soon as it hits your account, it's considered ordinary income. You owe taxes on that. Taxes are due immediately. Immediately meaning in that tax year, which really is April of the following year. The good news is your company usually withholds some of those shares so that you're not hit with a massive tax bill in April. As soon as the stock hits your account, that 1-year countdown starts from where you flip from short-term capital gains to long-term capital gains or losses. And that's based on how long you held the stock for since the day it hit your account. Again, short-term versus long-term capital gains. Short-term capital gains is taxed at your ordinary income tax bracket. Long-term capital gains is taxed at 15%. Your financial plan may dictate whether waiting for long-term capital gains or selling before that 1-year mark and paying short-term capital gains is in your best interest, but just know there is a tax discrepancy there that you could still benefit from. Again though, the countdown starts as soon as the stock hits your account and you have control. If you sell the stock immediately, if there's been no fluctuation in price, then you don't owe any capital gains or losses. If there has been any fluctuation in price, which there probably has been, at least if it's been a day, you'll either have short-term capital gains or short-term capital losses. In technical terms, the basis on that stock is whatever the fair market value is when it hits your account. From whatever hits your account to whatever it grows to, that's going to be considered capital gain. This is different than employee stock purchase plans that have a discount and a look back and all that. It's actually pretty simple with restricted stock units. As soon as it hits your account, that's your basis, and that's considered ordinary income. Whatever it grows to, that delta is considered capital gain, either short-term or long-term. So what are some best practices with restricted stock units? Well, obviously when it hits your account, you're gonna pay some ordinary income, and then you have to make a decision. Do I keep the stock or do I sell the stock? Going back to our original analogy, I would consider the fair market value of the stock when it hits your account as a cash bonus you received. If you otherwise would have taken the entire cash bonus and dumped it into employer stock, then I would do nothing different than when the restricted stock unit hits your account just to keep it. However, if you were to have gotten a big check in the form of $50,000 in cash and you wouldn't have invested all $50,000 into your company stock, then I would use that as an objective way to make decisions as to how much to sell out of the restricted stock units to then go and diversify, pay off bills, whatever it is you were planning to do. There's no tax benefit into keeping restricted stock units versus keeping any other stock. Now there is a little bit more nuance relative to timing the sale of your stock. I don't believe in market timing, and the best minds in finance would probably agree with me as it pertains to making decisions on individual stocks. That said, if you do have the stock and the stock is down relative to where it was when it first hit into your account, you have a decision to make. You can either try to wait for the stock to recuperate and either pay short-term or long-term capital gains depending on how long you waited, or you can just take the loss. For those of you who have been investing for a long time, you know that taking capital losses in your investment account isn't the worst thing in the world. If you do sell the stock for a loss, you have 3 major options. Number 1, you can use those losses to offset any other future gains you have in that calendar year or in future years. This would look like if you lost 20 grand from when your restricted stock unit hit your account to when you sold out of it, you can use those 20 grand to offset 20 grand of gains you had elsewhere. So maybe you had another portfolio that gained 20 grand and you sold that stock and you recognized 20 grand of gain. You could offset that gain with the loss you took from your restricted stock units. That'd be a wash and you wouldn't owe any capital gains taxes that year. But let's say you only made 5 grand elsewhere, but you took 20 grand in losses. That $15,000 of unused losses, you can carry forward into future years to offset future gains until all $15,000 left of that loss has been absorbed by future gains. That's kind of a nice thing. It's called carrying forward losses, and as of 2022, you can do that indefinitely. Your third option, if you do decide to recognize a capital loss on your taxes, is you can use up to $3,000 each year to offset your ordinary income. So let's say you made 100 grand this year, you're gonna pay ordinary income tax on all 100 grand. You could use 3 grand of your capital loss to essentially only report to the IRS that you made 97,000. That obviously saves you some taxes because that is your new adjusted gross income, and the IRS is only going to tax you on that. So there's a little bit of nuance with taking that loss deduction, so I'd definitely speak with a tax professional if you want to do this. Plus, any unused capital losses, you're going to want to make sure you track on your tax return so that you don't lose track of that for future returns. At the end of the day, restricted stock units are a great form of compensation. I would very much look objectively at them as cash as soon as they land into your investment account and make a proactive decision as to what to do with them, assuming you had cash instead of the stock. To keep it simple, if you would have invested all that cash into company stock, keep it. If you wouldn't have done that, then I would recommend selling out of it to some degree. I think last time I checked, the Certified Financial Planning Board recommends we keep no more than 10% of our net worth in any one particular stock at a time. There's other authorities out there in the financial space that say, hey, no more than 5%. Others that are a little bit more liberal saying, hey, no more than 20%. Obviously, if you're a business owner, the vast majority of your net worth is going to be tied up in your business, so you're all in violation of that rule, myself included. However, it could make sense for your situation to be a little bit more liberal, a little bit more conservative. There's some other variables you're going to want to factor in than just being dogmatic on a 10% rule. Again, though, just to be clear, I do want to fall in line with what the Certified Financial Planning Board recommends, and I would say 9 times out of 10, you absolutely should follow that recommendation, because rarely do I ever see somebody blow themselves up financially if they have a long-term time horizon and they're very well diversified. It's mostly when they're too concentrated where people tend to blow themselves up. If you do decide to keep the stock, then I would go back to the drawing board and come up with a game plan as to when you will diversify. So maybe you're outside of those 5 to maybe 20% net worth boundaries, and maybe 50% of your net worth is in your company stock. Again, there's pros and cons to doing that, and as long as you've made an informed decision, that could be in your best interest. However, I would still come up with a diversification strategy, and that would look something like this. As soon as the share price hits X, I'm going to diversify out 10% of my stock. Then when the share price hits Y, I'm going to diversify another 10% and take it in tranches. That way, number one, you're always selling at a gain, but then 2, you are objectively diversifying over time. Of course, if you have a financial professional that you can make this agreement with in writing, it absolutely helps increase the accountability that we won't be swayed by any sort of emotional decisions such as, hey, stock's doing well, let's not sell out, let's see how high we can get this stock price. That's usually not a winning strategy. On the other hand, a minority of folks do it very well by having too much risk in one area. The majority of folks do not do super well when they have too much risk in one area. So speak with your financial professional and just make sure that you're objectively deciding what you want to do rather than just reactively keeping stock because you were given it. So what's your call to action? Well, I'd identify if you are entitled to restricted stock units. If you are, you're going to want to figure out what your vesting schedule is, and you're going to want to come up with a proactive plan as soon as the stock hits as to what you want to do. It's very easy just to let the stock sit and accumulate, and then when it goes down, we get frustrated that we didn't sell out early. So if you can come up with a plan ahead of time, that's a best practice. We spoke about your investments in relation to your holistic financial plan, so speak with your financial planner. We spoke about some of the tax ramifications that go into this, so I'd highly recommend speaking with your tax professional. If you have any other questions, just let me know in the chat below or send me an email. We'll get you squared away. Have a good rest of your week. Bye.